好了，好了，可以开始。
没有，你是哦，我讲什么1、2、3。program change for director. It's directly responsible dividend policy, which is influenced by a number of factors. Deciding how much dividend is a key thing. You want to have such a dividend you can ask the company without ever getting the risk of causing yourself a capital problem. Either not being paying dividend must be insane revenue or who must have produced it. To pay dividend is to say that you have retained earnings and you have to have cash. And that is the reason why dividend is tend to be smaller with company because you pay a dividend to the shareholders. You can use that to business. The retired investors are looking for current income but not really appreciate stock. The dividend is really important. And certain stock funds require dividend before you buy a company, an investment company. So dividend is open to large file for a corporate. First, cash stock dividend. And what you will find is corporation that have lots of flow. Either it doesn't have lots of stock standing in the market. They'll pay frequently stock dividend is does two things. One is doesn't cost many cash and two it get more stock out of the market. And the broader you got your stock, the more neutralized they can buy your company. A board director may also increase their by carrying stock split. With stock split, what's the most common premium at 2-for-1 is easy to understand. You typically see on the day and its now stock price will move from 50 to 60 and within the issue the stock become half from 6 to 30. But it still got a lot of appreciation. In Syntech, we use stock split more than a couple times in our history. Most reason we split our stock 2-for-1. In our case, what the stock can down around to $80 for our share price. We want to bring it back down until we could see it trading in 2034 because investors tend to buy more aggressively. Dividend transaction need to record for the effect are reported in company financial statement. This is not what involved when board directors determine that is going to give a cash dividend. First of all, there is a 3 days advance here.
The number one is that of declaration. This is a date the board directors says we will at some given days of the future distribution dividends. At that point, they have legal ability to or few other partners to distribute this dividend in a date in the future. And most report is decreased return earnings and is legal liability. Now we get to the next stage. This is a date of report. Whoever wants stock on this particular date will receive the dividends. On the date are known to distribution. It's no accounting system on the date of report. We just may start writing figure on the next date. The third is the day of distribution. Now we will send director to this old stock list structure. This is a rather obvious provision to satisfy a liability. Ability decrease and others is cash dividend. So as a cash decrease, accounting entries of the payment of cash dividends, the gain on the date of declaration, cash dividend declared is debt amount. In this example, $5,000, and common dividend payable is 5-cent amount. No entry is declared the date of report. On the date of distribution for payment, the entry is debt common dividend payable and credit cash. Finally, at the end of the preparing period, the balance of the cash dividends declared the account is closed, with also reduced of retained earnings. As we've seen, cash dividends reduce corporation assets and equity. However, stock dividends do not affect asset or securities price. Now take a look at stock dividends. We have a situation or a corporation will callable, but they have a plan to cash right now. Do not want distribution. Cash right now they want to get something to the stockers. So what do? They have a bag of share available. The distribution the shares to the stock for free to the stocker.
好，
Regardless of the size of dividends, whether it is small stock dividend or large stock dividend, the net effect is exactly the same. we have a reduction in earning equivalent to whether we evaluate the dividend at, and we have an increase in stock accounts, leaving a corporation in the same financial position, shifting us the component of equity. Note that the total amount of equity remains the same, regardless of the size of stock dividends. Retained earnings decreased and contributed capital increased. Any dividend between 1% and 25% of the outstanding stock will be considered a small stock dividend. In that case, we use the market value, as it is considered to be a fair evaluation of the stock. But what happens if the corporation chooses to declare what would demand large dividend, something greater than 25% of the outstanding stock? Here we have the hands of also stockholders, a great number of additional shares that they receive for free. Maybe the market will be flooded with a great matter of additional shares at a particular point in time. What do we expect that's gonna do to the market price of the stock? It's definitely going to reduce the market price on stock. So will market value be a fair valuation of that event in that case? Obviously not. So now we have to find another way to evaluate the dividend. If it is a large stock dividend, we simply use the par or stated value. How about journal entries? First, consider small stock dividends as soon as 10,000 shares of $1 common stock is outstanding. The board of directors decide to give a 10% stock dividend. The market value of the stock is $5 per share. On the date of the declaration, stock dividend declared is debit $5,000. The market value of the share to be issued. Common stock dividend distributor is credit for a total par value of $10,000. The rest is the credit to the contributed capital in excess of par value.
There is no transaction, so there is nothing to record. Finally, the date of distribution, the stock is actually distributed to stockholders. Common stock dividend distributable is reduced with a 10,000 debit. Common is credited at 10,000. Now, let's look at the same company but with a more general attitude. Instead of 10% dividend, the board declared a large stock dividend, say 40%. Remember, with large stock dividend, we use par value to record transactions. On date of declaration, debit stock dividends declare $40,000. On the date of record, no transaction and no entry. The last entry is on the date of declaration. Common stock distributable is debited $40,000. Common stock credited the same amount of $40,000. As with cash dividend declared, stock dividend declared is closed into retained earnings. Let's think about stock split to a moment. I am sure that you've heard that terminology. You read in the financial press all the time about stock split. What does that mean? Not very much at all, because it's been no additional investment. We do not have any additional assets. There is no additional equity. It's more or less than paper transaction. What happened is the par value of that stock is changed accordingly. Let's say we have a 2-for-1 split on $1,000 par value stock. That stock will now carry a 15% par value, because remember, the balance in the stock account has to equal the par value of the outstanding share. So we double the outstanding share. We now have to show the par at the half of the original amount. This is often done by corporations in an attempt to make its stock more marketable.